Valens Research, Uniform Financial Analytics.
Valens Credit Weekly Insights report in your investment process and how you can use the Valens Research app from a credit perspective. But first, because we do know that as much as we don't like victory laps here at Valens, people do care to see whether or not the proof is in the pudding, and there's actually been good performance with the insights that we deliver historically. I'm just going to take you through a couple of the historic Valens Credit Weekly Insights reports that we've produced so you can see the kind of insights we've identified and the performance of them. You know, in the newsletter, we obviously, in the invite that we sent to this webinar, we obviously highlighted Navistar, which since 2013 we've seen basically have a 65% improvement in credit risk in terms of a fall in credit risk, while the market's basically been flat because of the insights we saw at Valens. And AMD, which we've seen basically go from a company bordering on bankruptcy when we first identified it as an idea back in 2015 and before, to now being a name that's practically investment grade with 100 basis points CDS. And Wyndham, which is a name that we've highlighted regularly as a name that has higher credit risk in the market, it was understanding. And obviously, since we highlighted it since 2014, it's been up. The credit risk of the name has risen by 50% in terms of the market credit risk. But those are a few of several ideas that we identified. Just for context, if I were to choose one, for instance, the May 17th, 2017 Valens credit report that we produced, one of the companies that we highlighted in this report was AerCap. AerCap, for background, for those who don't know it, is an aircraft leasing company. What we noticed with AerCap, which is the reason why we felt that, one, Moody's was misrating this bond, and the company itself, with Moody's giving the bond a Baa3 rating when we thought it should be a high yield 2 rating in the Valens Research form of analysis, which would be equivalent to a B2 rating by the Moody's, or B2 also or just B by the S&P or Fitch ratings. One of the reasons why we saw that, and we also felt that the bonds were being mispriced with a yield to worst of 3% when we thought it should be 4.5%, was because of this chart right here. What this chart right here is showing, and I'm going to zoom in to make it easier for you to see, is to actually show you what is going on in terms of the credit risk of this company. And so what you're seeing is forecasting for the next 7 years. These bars are the obligations the company has each year. These are in millions of dollars, these bars. And we stack the bars in terms of the obligations for each year from 2017 to 2023, right? We wrote this report in 2017. From the hardest for you to remove, for you to avoid paying, things like debt maturities and interest expense that are at the bottom of this stack of bars, to the things that you have the most discretion over, things like maintenance CapEx, pension, or also other uses of cash, things like share buybacks or acquisitions. We then compare those bars to the blue line here, which is the cash flow the company is forecasted to generate each year over the next 7 years. And we also compare it to the cash flow plus the cash on hand, which are these blue dots here, and the cash flow, cash on hand, and any revolver availability that the company has, which are these triangles here. So you can imagine, if we have a blue line here and a blue dot here that are below all of the some of the company's obligations, that means this company, without accessing the markets for more liquidity or without reducing its obligations, is going to have a cash shortfall. And so what we saw here with AerCap that was really important was AerCap was expected to have a cash flow shortfall on its obligations as soon as 2018, and really 2017 if they didn't cut back their maintenance CapEx much. Now, of course, what we understood about AerCap was AerCap also, though, has a phenomenally strong asset base. When we look at our uniform accounting adjusted recovery rate, which is when we analyze whether or not a company has assets backing its debt, we see it's very high. And because of the leasing nature of this business, generally AerCap can refinance their debt. And if they refinance their debt, these slashed bars here, if they vanish, right, this company won't have any issues handling its obligations. It'll just have interest expense and maintenance CapEx, and its blue line right here is well above those levels. The issue, though, is because of the fact that they have significant debt maturities each year, they are increasing their refinancing risk that any given year, if the market is closed for business, if, for lack of a better word, we're looking at 2008 again, where a company even like this or a company like the MLPs couldn't access the credit markets because of the fact there just was no lending at all, well, all of a sudden you have significant risk of a distressed situation for the company. Hence, why are we looking at an ICDS, right? Our intrinsic CDS, our fair value of CDS, that at the time was at 260 basis point versus an actual CDS of 112 basis points. Why we thought the bond should be 150 basis points wider. Well, since we highlighted this name last year, the bonds have moved wider by about 100 basis points. They're currently yielding north of 4%. Because of a lot of the issues that we're highlighting here, the market understands there is refinance risk of this name, among other issues. The market has started to identify what we were seeing earlier because of the fact that we were using uniform accounting. Another name that we highlighted on this report was GameStop. And for GameStop, we were seeing much the opposite. Well, Moody's was rating this as a high yield name, a BA1 name. We actually felt it should be a BAA2 name, an investment grade name. And we felt the bonds were actually mispricing the name, and they were about 130 basis points too wide, yielding 5.6% when they should have been yielding around 4.3%. Why? Because we're seeing the exact opposite picture from what we saw with AirCap. Well, AirCap had regular refinancing risk the market wasn't pricing. GameStop has a very healthy buffer in terms of its cash flows and cash on hand relative to its obligations. They only have 2 debt maturities in the next 7 years. They did back in 2017, only have 2 debt maturities in the next 7 years. And when they didn't have debt maturities, cash flows were going to exceed obligations every single year. Honestly, this company could see their profitability fall by 20 to 30%, and cash flows alone would still exceed all obligations other than debt maturities every single year. And on top of that, they've got these blue dots, they've got cash on hand that was north of $700 million. They had a cash buffer and they had room for profitability to decline before they had any issues. Because of that, we could see that the credit markets and Moody's, who were viewing this company as a high yield credit risk, were misunderstanding the fundamentals of the business. Since we highlighted it, bond yields overall have moved wider, as the credit market obviously has moved wider because of the risk-free rate rising. The bonds here have not moved wider at all, though. In fact, they've stayed flat because of the fact that the credit risk has been adjusted. Spread to worst has fallen as the yields have remained the same because of the fact the market is repricing the name. Other examples of insights that we've seen that are similar include, for instance, in November 2016, where we highlighted AK Steel. For AK Steel, what we were seeing again was an idea that while the rating agency was correct in their rating for AK Steel, right, in terms of the default risk of the name, with a B3 rating versus our high yield 2+, which is basically equivalent to a B1 rating, the credit markets were dramatically overstating the credit risk of this name, with a CDS of around 600 basis points when it should have been 300 basis points based on the fundamentals, and a yield to worst on the bonds of 6.5% when they should have been 4%. Why were we seeing this insight? Again, it comes back to looking at this chart right here and understanding the fundamentals of the business. One, we understand from the recovery rate analysis, which I'll go into later, that the asset backing of AK Steel is really robust. But more importantly, what we could see here was a name that's trading at a 600 basis point CDS. Really, you would expect to have cash flow and cash issues in the next 1 to 3 years. Likely that they're going to be able to navigate, but you'd expect to see these bars here at least threatening the blue dot here in the next 27 to 2019 time span. On the other hand, we don't see that. Because of the cash buffer that this company has and cash flows that are basically at least matching all of the company's obligations other than debt maturities every year, it's really not until debt maturities kicked in 2019 that the company was going to even have to see a burn down in terms of their cash on hand levels. And not until 2020 that cash flow and cash on hand would fall short of all obligations, including maintenance CapEx. And importantly, because this is a company that has been rational on their maintenance CapEx, if the company was able to continue to be rational in their maintenance CapEx and reduce it, really not until 2021 that we would have a true shortfall and issue for this company's profitability. And because of that, we were saying, hey, this is a company that does have credit risk, but the credit risk is far enough out that to view this name as a high yield name with a 600 basis point CDS and a plus 6% yield to worst was unreasonable. Since we highlighted the name, the CDS has moved 150 basis points tighter to south of 450 basis points on its way to our ICDS levels. and the bonds have also adjusted. Similarly, we saw something really interesting with Chesapeake. This name back in 2016 when we wrote this report was a name that was really viewed as a high bankruptcy risk, right? The 2020 bonds were yielding 10%. And the CDS of the name was 940 basis points with a yield to worst of the bonds of 800 basis points. This was of 9.5%. This is a name that was truly priced for bankruptcy. Why? Because the fact that the market saw, as reported, EBITDA interest coverage ratios that looked terrible, and saw limited cash on hand, and they said, hey, this is a company that could have a crunch. But when we looked at the uniform accounting numbers for this name, we saw in reality a company that cash flows were likely to exceed their obligations in terms of maintenance capex and their debt maturities almost every single year, and we didn't really see significant debt maturity headwalls until the 2020 to 2022 range. We had an ample runway for this company in terms of its obligations relative to its cash flows. And because of that, we knew that this company was not a company that was going to go bankrupt. They were going to be able to manage through this. What happened since then? The CDS fell from basically to 300 basis points to 400 basis points tighter, and the bond yield to worst fell to basically 5%, really highlighting the fact the market identified what we were already seeing. Just one other example, in terms of from a prior report, and then I'll jump into the current report, is CCI here, right? This is a name where we were saying was interesting because for CCI, the equity markets were actually trading CCI like CCI was a company that was a phenomenally strong company with improving profitability. But the credit markets with a CDS of 300 basis points were saying really that this was a name that had some hair on it, right, for lack of a better word. What we're saying was interesting was one of those two markets needed to be adjust their expectations for us to see the for the company to be fairly valued and for this, if you will, arbitrage opportunity to close.
Valens Research, the world's leading source for uniform financial analytics.